Welcome, everybody. Welcome and good morning. And I've got good news for you. We are still on the air. They have not totally censored us yet. Facebook has kicked us off, but they say we'll be back on there in about 3 weeks. If we're lucky, if the Communist Party of Silicon Valley allows it, we need to bow to them. We need to pray that they let us speak because they don't like anything that doesn't agree with the agenda. In fact, in one day last week, Twitter deleted 4.5 million accounts. 4.5 million accounts deleted in just one day last week. Twitter stock, by the way, is down 12% after kicking President Trump off the platform. He was, I believe, the most followed person, or right up there toward the top. And hopefully we will see similar declines in stock prices of big, evil censorship, big brother companies that really do the wrong thing. And, it's interesting. These companies are using these fake excuses, of course. They're saying, there's violence. If you actually look at the two tweets they're citing in President Trump's case, there is nothing violent about those tweets. There is nothing you could ever interpret as being violent. There is no hint of violence in the two tweets that Twitter says they kicked him off for. Go and do the research, folks. This is censorship, pure and simple. It is scary. It is disgusting. It is Orwellian, and it's 1984, George Orwell. But even, just as a thought experiment, and Adam, I'd love for you to jump in on this before we talk about jobs report, housing supply, if there is any housing supply. And actually, I don't know why I'm laughing at that. I'm laughing because I just need relief from the pain of the lack of housing supply.
Sometimes you have to laugh instead of cry.
Right. Yeah. It's either laughing or crying. So maybe I'll cry later. I'm laughing now. And then we'll talk about investment opportunities, and Adam's got some stuff to share in that. But, when they did the midnight ride of Paul Revere, can you imagine if the company that made the candles said, you can't use our candles. We're going to deplatform you from using our candles because they're fomenting violence. One if by land, two if by sea, right? That was the deal, what Paul Revere would do when he was going through the town on his horse. And imagine if the owner of the horse said, we are deplatforming you. You can't have a horse because you're Paul Revere. You are fomenting violence. And then imagine if the company that supplied the feed for the horse to eat said, the owner of the horse, Paul Revere in this case, ostensibly, I don't know that to be a fact. Maybe the fact checkers should come out and, check that fact, because I might be wrong. Maybe Paul Revere didn't actually own the horse. Maybe it was a leased horse owned by a big leasing company that didn't like what he had to say. What?
Owned by Big Horse?
Yes, owned by Big Horse. I love it. That's good. Instead of Big Tech, it's Big Horse. Yes, that was the big supplier in the time that had the monopoly on horses. But imagine if the feed company said, you know what? We're going to stop supplying feed because we want to starve your horse, because Paul Revere, riding through town at midnight, after he sees the two candles in the window, one if by land, two if by sea, he's fomenting violence. You can't resist the powers of the British. God forbid! No, don't do that. Don't do that. But it's pretty scary times. But the one thing we know for sure that we've seen throughout history with dictatorships, whether it be the Nazis, whether it be Kim Jong-un in North Korea, or Kim Jong-il, his predecessor, or any of them, right? Fidel Castro, when he was alive in Cuba, is that they are self-immolating. They destroy themselves. They are like a cancer. As these virtue signaling woke people, try to be, through time, they try to be more and more woke, right? Because they are hiding their own racism, their own homophobia, and their own, flaws. what they do is they start to attack themselves. The group starts to destroy itself. And you can see this, there's lots of examples of this, but it is a cancer, and it's a very dangerous precedent to have this kind of censorship. But look, these are private companies. People say they can do what they want. But they have GDPs bigger than many countries. In fact, Facebook's GDP, there's about 200 countries on Earth. Facebook's GDP, if it were a country, would be right around number 71 in the world. Okay. Now, do you think the 130 countries, not companies, below Facebook should not have free speech? They should not have human rights? Twitter, right up there. Amazon, Apple, right up there. Apple, the company that employs all the sweatshop workers and abuses children with her disgusting child labor practices, and they fix prices so that app publishers get a terrible deal. And these companies are just evil. They do all sorts of terrible, disgusting things. Yes, we all love their technology, but it's our fault. We made them big. We bought their stock. We used their platforms. We gave our lives to them. We gave our attention to them. And now we're paying the price, sadly. So here we are, still on the air. So as Robin Williams said in the great movie, "Good morning, Vietnam." Adam, tell us about the jobs report, housing, or any comments you have on my little monologue.
Well, to me, the biggest thing is we've just never seen this environment before. We've never seen, the internet first off, but then also the massive, huge companies, and we just don't know how to deal with it as a society and as a, even as a government. It's kind of, how do you stop this company that's worldwide that, does, so many different things, and we just don't have a plan to, to curtail them in any way. I mean, there's just no plan. I mean, I have, whatever you think about the company, good, bad, indifferent, the fact is they can do whatever they want right now because we never came up with a plan on how to deal with this situation.
Yeah, right. Well, the plan we never came up with is that, when the internet was young, we implemented the CDA, the Communications Decency Act. Like all these acts, they're so inappropriately named. It has nothing to do with communications decency. And what we did is we exempted these platforms because they didn't have to abide by the same rules as publishers. They got to claim, look, we're just a platform. We don't publish material. Other people use our platform to publish. So we shouldn't be held to the same standards as the LA Times, the New York Times, CNN, the Communist News Network, or Fox, or whatever, MSNBC, right, or ABC. We're just a platform, right? But what we found is that that's simply not true. Even if they never publish a single word, which they do publish, by the way, that's just a lie. But even if they never publish, say they were incredibly clean and they never published a single word of their own, they have so many people on their platforms that they can publish, in quotes, by deciding what is seen and what is not seen. They can publish by redaction and promotion. That is a form of publishing. And just to go back to that example about the typical media platforms, if you call in, say, for example, CNN had a talk show where you could call in, and they've had those where people just call. Certainly radio stations do that. If you call in and you say something on the air that creates liability, they have an obligation. They have a delay, right? They'll have and Adam, you used to work in.
Yeah, you got a dump button.
Right. What do you call it?
A dump button.
A dump button. Okay. And what was it, like a 10-second delay?
I think it was 8.
8 seconds. So you got to sit there. Someone's got to sit there at that button. And if the person says something wrong, if they swear, whatever that would violate FCC rules, or if they say something that could create liability, say they were defaming somebody else by, saying, so-and-so is an, evil liar, cheater, thief, if they say that, they would have to dump them, right? Because they'd be responsible for that content. And the big platforms, YouTube, Facebook, Twitter, all the rest, all of them, Google, they edit not by publishing. It's interesting, not by publishing their own content. They edit by deciding what gets shown and what doesn't get shown. Isn't that interesting, Adam, that it worked out that way?
Yeah, it is. And like I said, I personally don't know how you how you deal with that as a society, because unless you just limit, how many people they have on it, or something like that, it's really
Well,
a tricky.
here's the thing. The market cap per employee of these companies. What's also interesting. I was watching a great video last night with Scott Galloway, and he wrote a book called, I think it's called The Four Horsemen, and it's all about the giant tech companies. I think at the time he wrote that book, maybe 5 years ago, it was Amazon, Apple, Google, and Facebook. And he talked about the market cap of the company per employee, and how and by the way, Scott Galloway seems like a pretty liberal guy. It's just my impression. I could be wrong, but that's, I've followed his content for a while, and he seems pretty far to the left, I'd say. So Scott, if I'm wrong, correct me if I'm wrong. Maybe you're a right-wing radical. Oh, don't say that. I'll get censored. But we hold these companies up as like some, great companies in America, right? They don't employ people worth crap. In fact, they are the biggest job killers in the country, because they've learned, and you got to give them credit for this in a sense, how to do so much more with so much less through technology. They are killing jobs left and right. I mean, they're the biggest job killers ever, these giant tech companies. And so the market cap per employee, he had a chart at him. It was fascinating. I'm gonna go watch that video again and take a screenshot of it. It showed the New York Times market cap of the New York Times per employee versus the market cap of Facebook, Google, and I can't remember, maybe another one, per employee. And it's like shockingly different. It's maybe hundreds of times more in the tech company than it is in the old-fashioned company.
Oh yeah.
And people say, it would be an unfair burden. There's no way Facebook or Google could regulate their platforms, because millions or billions, literally billions of people use them. But so what? These companies shouldn't be allowed to have such a big market cap. They should have to hire more people to police their platforms, or they should just let it be a free-for-all. It's got to be one or the other, because it's not fair for anyone to be able to choose, because they always have their own agenda. Go ahead.
All right, you want to get started?
Yeah, I do. But any thoughts about that?
No, I just what I've said before. It's just we don't know how to deal with this, and we've just been sticking our head in the sand rather than dealing with it. It's easier to kick it down the road.
Yeah. No, it's a tough problem for sure, but this is a bad precedent. Hate the president if you want, that's fine. And isn't it great that we're in a country where you're free to do that? It's awesome. But maybe when there's a Biden administration, if you post all kinds of stuff about how you hate him, that'll be censored or ghost posted or whatever. Who knows? We'll see. We'll see. All right, Adam, let's dive in and let's talk about jobs and housing supply. And I'm going to start crying soon.
Yeah, so let's start with the jobs report. Well, first off, income property is the ideal investment, as we talk about every other week here. If you have any questions, comments, need any help, 1-800-HARTMAN. If you're in the U.S., jasonhartman.com. You can come check us out. So this is a clip from the Marketplace Morning Report podcast that I was listening to on a walk the other day. I'm going to see if it works here, if I need to put my mic up to it. So let me know if you don't hear.
You probably have to put your mic up to it.
Did not rise, but instead fell. The government's December number today fell by 140,000, with special weakness in one sector, restaurants closing amid new coronavirus restrictions. And while the report shows average hourly wages rising last month, that's an artifact really of averaging lower wage workers losing jobs, leaving higher paid ones. Economist Christopher Lowe is at FHN Financial.
In fact, almost 500,000 job losses in leisure and hospitality, 3/4 of them at restaurants. It's the new lockdowns in California and New York that hit hardest this month.
I mean, that then suggests that the rest of the labor market is not doing as badly.
No, it's not. And in fact, the highest paying jobs in the goods producing sector, manufacturing, construction, and even in the oil producing sector, they were quite strong. Goods producing was up 93,000, which is a really solid rise. In fact, we're looking at the strongest manufacturing in the US in the last 4 or 5 months that we've seen in a decade.
All right. So the reason I had this on is we have talked about, recession, whether that's coming again. And it's important to note that we need to differentiate states and markets, because as you heard in this, this guy's telling us we're seeing the strongest manufacturing in the US in the last decade, but jobs numbers look terrible because California and New York are losing all their waiters and waitresses. So there's a very different economy out there in the markets that we're investing in, the markets that make sense, than what you're hearing in the media.
Yeah, Adam, I'm glad you brought that up. All real estate is local, and the media is almost always reporting a national picture, right?
Yeah, absolutely. Because honestly, and I kind of hate to say this because it's going to sound bad, if California real estate crashes and burns and it makes the overall US housing market look bad, that's not going to impact my investments. My Atlanta properties, my Memphis properties, my Jackson, Mississippi properties, they're not going to get, impacted much by it. The workers that I have in Memphis who are manufacturer workers, they're not going to be losing their job because a waiter in, California or New York lost their job. It's going to look bad overall, but in reality, outside of those two places and those two, specific industries, it's looking pretty good right now.
Well, and the interesting thing about what you just said is that California, because it's the largest state in terms of population, it's about 40 million people, it's more heavily weighted. Remember, of course, when we talk about the way they manipulate, for example, the consumer price index, the inflation metric, they do it through weighting, substitution, and hedonic indexing. So this is weighted. So, the even the anecdotal discussions about it is weighted because California has such a big impact, given that its population is so large. And you talked about, Adam, how it's not going to affect your properties in Atlanta or Tennessee or Florida or the other markets we're doing business in. Actually, I would argue that it would help those properties because people are leaving California. Now, granted, this is tricky also, by the way. I haven't looked at this lately, but I believe California still shows a net population loss. It's fairly minor, though. It's not huge. It's not like, 3 million people a year are leaving the state. But what you have to know about that is you got to read between the lines, because the people who are leaving are more economically valuable than the people who are coming into the state of California, because it's a southern border and it's got the illegal immigration problem, or sorry to use Hillary Clinton's politically correct term, the workers without papers people. I'm not blaming them. They're just trying to find a better life. I would too if I were them. But it is what it is, right? And so when you look at net population numbers, it doesn't really paint the right picture. It's the who in that population. What California is losing in droves is middle class and upper middle class people, and a lot of them own businesses, a lot of them have money. And Adam, how you benefit from this is that they come into these other markets that are so much less expensive and where tax rates are lower. And it's kind of like, I'm sure you, Adam, or people listening have been to a foreign country where the exchange rate is very favorable. You go at a time where you kind of get lucky and the dollar is very strong, and whatever country you're going to has a weak currency vis-a-vis the dollar. So your money spends great. You can live like a king or a queen. And, it's like a wonderful experience. That's how Californians and New Yorkers feel when they come to Tennessee, Florida, Georgia, whatever, right?
Yeah, absolutely. I mean, all the clients I've talked with who are either leaving California or selling their California property are like, man, I can buy 5 properties.
Yeah. Yeah, they can get a nicer home for themselves. They can get a castle for themselves compared to the shack they had in New York or California. And they can have a lot of money left over to become real estate investors or to pile that money into the stock market and drive up the stock market. Oh, by the way, Adam, there's this excellent video. It's too long to ever share on the show because it's like an hour long. But I think it's called The Greatest Ponzi Scheme in History. And I thought it was going to be about Social Security or Madoff or something like that. It's about Wall Street. And there are a lot of nuances that I did not understand about how the way Wall Street works on the inside, about how it really is a Ponzi scheme. This is quite interesting, but another topic for another day.
Yeah. So I just wanted to show that because, you're going to hear a lot about, job losses, but it's not all bad. So now let's talk about housing supply. And this is where things get a bit brutal. If you look at this is from the end of November of 2020. I got this from Redfin. They didn't have anything from the end of December yet. So this is the newest I could find. And the number
now, Adam, when you say brutal, I think you need to, remember what's brutal to one is advantageous for another, right? So define that, brutal.
Yeah, so for a home buyer, it was brutal. Yeah. There are over 900,000 fewer homes for sale now than there were in November of 2019. That is a 38% drop year over year. I mean, 38% less inventory right now than there were. The median days on market has dropped from 45 down to 27.
Wow.
And we have 1.6 months of supply. It has been cut in half since a year ago.
And by the way, the supply a year ago was not large. Okay. So generally speaking, this is an opinion. It depends who you talk to, but many experts will tell you that about 6 months of supply is sort of a balanced market. Okay. So that just gives you a reference point. Go ahead.
Yeah. So, there are, an 8% increase on the newly listed homes, but a lot of that is just, they're selling so quickly that, you're getting a lot put on the market some, but there just aren't, many out there for actual purchase right now. So then you wonder, okay, all of that's happening. How's the demand? How competitive is the market? Well, no surprise to most people, incredibly competitive. 34.9% of homes sold above their list price in November of 2020. I mean,
that's incredible.
Yeah. Only 12% had to have a price drop of any form, which is down 1.9% over the previous year. And homes sold at 99.5% of sale to list. So you're pretty much getting exactly what you're asking for whenever you're listing your house. So buyers because everybody wants a deal, nobody's getting a deal.
Right. Yeah. But maybe they are getting a deal because when you look at that property on a monthly payment cost basis, houses are actually cheap. And we've, of course, talked about that before. We've done whole shows on that topic. So because interest rates are so low, and when you adjust for inflation, houses today, even now, even with everything Adam is saying, which does look really challenging for buyers and great for owners or sellers, right? But houses are actually cheaper than they were on a mortgage payment cost per month basis than they were 14 years ago during the peak time. They're cheaper now. So it's pretty incredible.
Yeah. So, but it's a good time to be selling if you need to move, if you're in the right place.
Right.
So you're,
And I would say that good time to be selling thing, I'm not selling any of my, I was thinking about selling some of my properties this year, but the market's just too good. I just can't bring myself to do it,
yeah, I'm talking
so
mostly primary.
yeah, primary homes that are more expensive homes, meaning, in more expensive cyclical markets, definitely high density markets, good time to be selling. I've got an interesting chart here. Of course, it's not in the slides, but let me just share this with you, Adam. And I won't do it visually. I'll just talk about it for a second. I just got this graph, and Evan sent it to me as well. 2020 saw an unprecedented murder spike in major US cities. Percentage change in homicides in selected US cities between 2019 and 2020. Seattle murder rate is up 74.1%. New Orleans is up 61.7%. Atlanta up 57.9%. Chicago 55.5%. Boston 54.1%. Portland 51.5%. Houston, where you're from, 42.7%. New York 39.2%. San Francisco, right? Super amount of gun control, everything, 32.4%. Los Angeles, my hometown, 30.4%. Washington, D.C., there's so many dang cops in Washington, D.C. I don't know how anybody could murder anybody there. There's just cops everywhere. It's like 5 police forces in D.C., 19.4% increase, and Las Vegas, 14.3% increase in the murder rate year over year. So,
well, the good news is the 30 years prior to that, the murder rate had been dropping. So
that's true. Yeah.
Very low.
Violent crime. But, again, that's another manipulated statistic. I've read some reports on that, not lately, but, look, I don't know. It may well be overall true, but I'm telling you, there are manipulations to that statistic like everything else. Okay. So, yeah, go ahead.
All right. So let's see what's next. All right. So then home ownership is unaffordable for Adam Data Solutions said home ownership is unaffordable for average wage earners in 55% of U.S. counties, up from 43% a year earlier. So it's becoming more and more unaffordable for people to buy a home, which means that more and more people are renting their homes.
Yeah. So, and I wonder what, when Adam Data's been on the show before, of course, many times, but I wonder, like the compared to what question there, compared to renting a home. I mean, just to say a home is unaffordable is a misnomer, because what happens is people adjust their expectations down and they end up buying or renting a lesser home. So, they got to live somewhere.
Yeah. Yeah. So then I decided to look and see how much a median home would cost. I just took 300,000 because it's a nice flat number that I can work with. And I know the median home value went over $300,000 recently. So if you have a $300,000 property, and this is for, beginning of 2020, essentially, $300,000 house, the average down payment in the U.S. is 6%, or right around 6%. So you're putting in $18,000. If you got an interest rate of 3%, which you couldn't get at the beginning of 2020, but let's just say you could get 3%. Your principal and interest payment is $1,189. Property taxes nationwide average 1.69%. So you'd be paying $422.50 a month for property taxes. So your principal, interest, and taxes comes out to $1,611.50.
That is actually pretty reasonable. When you adjust for inflation. But you didn't include insurance in there, I guess, because it varies too much by area, right?
I wasn't going to go that route. So then the FHFA said there's a 7.8% appreciation for 2020, which would make that same property $323,400. Your 6% down payment becomes $19,404. your mortgage payment goes up even at the same rate to $1,282. Your property taxes go up to $455 a month, and your principal, interest, and taxes goes up to $1,737. So it's a $120 a month increase. So you're paying an extra $1,901 per year. So this is how people are getting priced out.
Right. And so this is year over year. But wait, that's per year, right? Okay. 1901 extra per year. That's not per month. Okay.
Yep, per year. Okay. So these are, if you look at, all the people you heard before the pandemic, and now you're hearing again, they don't have $1,000 to cover, a major expense. So they're obviously don't have a ton of money extra in the bank. So just that 6% down payment increase to $1,400 is stretching some people.
Yeah.
And then you factor in, now you have to have an extra $125 a month to pay your mortgage. You see why an increase of $50 in your rent isn't as enticing to move out and go buy a house.
Okay. So Adam, let's circle back and address the misleading thing about this. Of course, it's not adjusted for inflation. So we take 7.8% appreciation, which is the FA number above. And let's assume that real inflation is 4 or 5%. Okay. We can debate that till the cows come home, right? So that'll take a little bit off of it, but it's still higher. Your cost is still higher. But what this doesn't show, the uninformed person looks at this and says, well, houses are becoming so unaffordable. How will anybody afford them? Well, they don't afford them. They reduce their expectations. They have to adjust their expectations down. Look, we all want to live in a mansion. We all want to drive a Rolls Royce. Well, it's figure of speech, right? But, we all want everything. But, in real life, we've realized that, we're not spoiled children anymore. We're adults and we don't get everything we want. So we have to adjust our expectations down. So they're going to take a lesser house, a smaller house, a house in a less desirable area, a house with a smaller yard, a house with inferior finishes, or whatever, right? That's what really happens. Go ahead.
Or they keep renting because they can't get the house that they want.
Yeah, or they just stay as renters. Yeah. And, when I started my career at age 19, when I was in college, I started as a part-time realtor with Century 21 years ago. And I noticed that over and over. I would work with I was selling government repos, HUD and VA repos. And when I was doing this, I was always working with one of two types of clients. Either they were an investor, and that's how I got so much to love investing and working with investors. They were either an investor or a first-time home buyer. And what I noticed over and over repeatedly is that first-time buyers, a lot of them, the smart ones would just get a house and, move in, fix it up. These were all fixer-upper houses. They were terrible condition. Yeah. But the people that you could tell were probably not going to gain much wealth in their life, they were the people that were never willing to take one step back to take two steps forward. And what I mean by that is almost always the rental that they were already renting was nicer than any home I could sell them. Okay. So they would have to take a step back to become a home owner. Right. But it was a time preference step, right? Where they viewed it as though, look, if I become a homeowner, that's going to be good for my financial life. And in the long run, I'm going to be better off, but I'm going to have to, get less now. And, maybe I'm going to have to spend my weekends fixing up the house. Right. They couldn't do that. They wanted all provided for them. They wanted, the manager, the owner of the property to have their property in perfect condition. They wanted to have that extra space, whatever. They could always get a little bit more in a rental, at least at that time, than they could in a house that I could find for them. So it was the ability to delay gratification, which is one of the hallmarks of success. In fact, that is the whole concept of investing, is delayed gratification. Because when you invest, what you're saying is, look, I'm not going to use this money that I have today to buy whatever I want, right? I'm not going to buy a new boat or a new car. I'm going to put that money to work for a bigger, better future, right? That's a decision we have to make. It's a time preference decision. Do I have a short time preference, meaning I got to have instant gratification and I got to have what I want now? Or do I have a long time preference where I will employ delayed gratification and do what's best for my future life and the future life of my family?
Yeah, and especially, I mean, right now, you talked about inflation eating down the, some of the appreciation. That's true, but you also have to remember that these people are having to come up with an extra 1900, and they're not seeing wage growth at the moment.
Right.
We have very minimal wage growth. So they're, now you're really talking about, okay, I didn't get a raise this year. I need to find, I'm going to have to cut back $125 somewhere else in my budget. Is it worth it? And just a ton of people are deciding it's not worth it to them, which is great for those of us who own the rentals and can say, okay, well, that $125, based on everything else that's going on and the fact that my taxes are going up, $30 a month, you need to give me an extra $40 or $50 a month now in rent. And they say, well, I don't want to, but I also don't want to spend, all this other money going out and buying a house. So it's really creating the pressure on the rents and giving us a good position to own property then.
Right. So understand these are non-correlating things, that when housing affordability declines, it simply puts upward pressure on rents. Go ahead.
Yeah. And so then I looked at, I found a Wall Street Journal article I thought was interesting, where they were talking about, rent payments and evictions and everything. And it says, though millions of Americans are still struggling to pay rent and at risk of eviction, the bet on six-figure earning suburbanites by companies such as Invitation Homes, Inc. and American Homes for Rent has so far been pandemic-proof. Occupancy of the hundreds of thousands of houses collectively owned by these companies is at record highs. Timely payments are in line with historical rates. Tenants are accepting rent increases instead of moving out. New renters hunting for home offices and outdoor space are paying up to move in. The demand we see today is totally insatiable, and it's growing, says David Singlin, Chief Executive of American Homes for Rent, which owns more than 53,000 houses in 22 states and collects an average monthly rent of $1,686.
Yeah. Wow.
So people have been calling us optimistic and telling me that I'm too optimistic about the economy. But you look at this, and I'm not the only one.
Yeah, no, you're definitely not the only one. I mean, look, folks, the doom and gloomers can say all they want, but the facts are simply not supporting these ideas that the housing market is going to crash anytime soon. I mean, look, there will be an adjustment. I will be the first to agree with that. There will at some point be an adjustment. But right now, there's a massive housing shortage. We have artificially low, super cheap rates. Housing is cheaper than it was 14 years ago on a monthly mortgage payment basis. There are a lot of tailwinds here. We've got the wind at our back for a while. It's not going to last forever. But,
yeah, and I mean the occupancy rates being high is not surprising because in all honesty, who wants to move right now? Yeah. I mean, now's a horrific time to move, and the timely payments. Even we've talked about how our clients aren't really having any much collection issues. I mean, these people own 53,000 houses, and they're doing just fine with their payments. So yeah. It's still, and this is pre extra money coming in, pre-stimulus money coming in.
Right, right. So 53,000 houses, folks. Now you can set a bigger goal for your real estate portfolio.
What have you done lately? Although they're in more markets than you recommend, 22 markets.
Yeah, well, they got a big staff to manage all of that.
They've got more
Our
than one or
clients,
two people.
by the way, what Adam's referring to is one of my 10 commandments is thou shalt diversify. And one of the big mistakes I made when I started doing this in 2004 is I personally over diversified and I bought too many properties in too many cities. I should have consolidated them a little bit. So we recommend that you buy in at least 3 markets. You should be in at least 3 markets, but not more than 5. Okay. And of course, you can see these properties and markets. There aren't many of them, so you really got to be working with an investment counselor, but you can get some market overviews and some information for free at jasonhartman.com/properties. That's jasonhartman.com/properties, or just click on the properties page. And you can see the different markets we're recommending right now. And you're not going to see much inventory there, which means you must contact us through one of our web forms, any of those forms on the site, and an investment counselor will be in touch with you to help you figure out which markets are the best ones to invest in, and what is best based on your risk tolerance, your time horizon, your investment goals. That's what we do. We help people do that. So be sure to reach out to one of our investment counselors. Go ahead, Adam.
Absolutely. All right. And then, so here's the question. What do you do?
Yep.
So this is,
I like that picture. That's a pretty funny picture.
I like it too. So I looked up, I was still on Redfin. So they had a thing of their states down at the bottom. So I just clicked on Alabama. So that's why I'm using Alabama. Thanks, Alphabet. So I looked at they showed the average list price and the average price per square feet in those markets, Huntsville, Birmingham, and Madison. We have properties in and around those 3 areas. So the average list price is anywhere from around $250,000 for Birmingham to $325,000 in Huntsville. Price per square foot in Huntsville is about $120, and Birmingham is $130. And this is not new construction stuff. This is just average listing, average price per square foot. We're able to get new construction properties in the Huntsville and Birmingham suburbs for, this is the Birmingham. This is a place it's about halfway between Birmingham and Huntsville. And so it's $209,900. So lower than both average list prices. It's $113 per square foot, which is lower than both of those markets' average price per square foot. It'll cash flow you over $300 a month, return you 6% of your cash on cash, and 32% total return on investment whenever you factor everything else in.
Adam, but you have to say the key word. These are all projections. Nothing is guaranteed, of course.
Yeah. So
and it might do better. Sometimes it goes better. Okay.
Yeah. So this is the way that you combat that, is you look for the markets that make sense, and you look for the investments that make sense. And you can do this on your own, or you can make it a lot easier and work with us. It's up to you, but these things are out there. You just have to, they don't just fall in your lap anymore. You've got to go out there and look for them and make it happen if you want it to happen.
Yeah. Okay. Yep, absolutely. You do. And we can help you. Just go to jasonhartman.com. Also, I've got it up on the screen, but I didn't say it, so I'll just say it for those listening on audio only. We have a free mini book at pandemicinvesting.com, a free mini book that can help you with your investing strategy during these crazy times that we're living in. And Adam, are we ready to wrap it up for today?
We are. Denver Gray wanted you to say the name of the
questions. Go ahead. Sorry. Good.
What was the name of the greatest Ponzi scheme? Was it?
Oh, the video.
Yeah.
I don't know. Let me look it up. Go ahead, Adam. Grab a couple other questions. I'll see if I can find it.
So, well, thanks to us getting censored, we don't have as many questions today.
That's true. Oh, blessing in disguise. Just kidding.
So Peter said, Jason, the bottom line is, what are you going to do about it? Well, I think we Said Biden is bought and paid for. He will just start some more wars, prop up corporations at the expense of regular people. Nothing changes. And Peter, that's, I mean, honestly, probably going to be true. And so what you do about it is you align yourself with, where everything's going. And we kind of talked about that today. You see the great part about the government and what they do is they come out and they tell you what they're going to do before they do it. Whenever the Fed makes, whenever the Treasury, spends a bunch of money and puts it into the economy, whenever we go to war, we're told for the most part, the government says, this is what we're going to do. This is what's going to happen. And we're able to jump ahead of that if you understand how it's going to impact things. And so, you jump ahead and you ride the front of the wave. And right now they're telling us, we're going to keep interest rates low. We're going to keep supporting the people who are getting hurt by the pandemic. So they're still going to be able to pay their rent. They're still going to be able to pay their bills. So you get in front of it and ride the housing wave, and you get in at the price now and you watch it appreciate. And maybe in 3-4 years it does drop some, but most likely it's going to drop maybe to the rate that you bought it at and not below at this point in time, it looks.
Yeah. The government does tell you, by the way, I put that link for the video on the greatest Ponzi scheme in the chat, so you can see it there. But in order to see it, you are required to click the like button on this video right now. Click the like button, folks. Don't forget. I always forget to say that. You got to ask, right? To he that asketh, it shall be granted. So click the like button. And also I put the link to our estate planning and asset protection web class. It's totally free with a great lawyer we work with. That link is in the chat as well. Adam, go on to the next one.
That was actually all the questions that we had today.
Well, it's so much easier when you live under censorship. You don't have much to do. Yeah, you can take time off.
But if you're listening to this on the podcast and have any questions, jasonhartman.com/ask. Send your question in. We will answer it as soon as we can. And for everybody who's even considering the asset protection, I personally have purchased it, and I can say I haven't done the asset protection seminar with the lawyer yet. But Jason, that call we had on Monday with him, the Zoom meeting that we had kind of as a large group, was incredibly useful.
Yeah. Oh, good. I'm glad you got a lot out of that. That's great. So every month we have a group called the Empowered Investor Network. It's like a social network, and thankfully it's not on Facebook. It's on our own platform. You can join that. That's something you can join. Just ask your investment counselor about it. They'll help you. And what it is it's investors and landlords working together to gain greater control over their investments. And so the class we had that Adam's referring to is we brought the lawyer on for a Zoom meeting, not a webinar, a meeting where we're all, you can see everybody and we're all talking and people can ask questions and stuff like that. So, but do check out this web class, and I think you'll really enjoy that. And Adam, we got a couple more since we started talking about how we've been so censored.
Yeah. Oh, my tinfoil hat! Congratulations! He mailed for dollars and got a 12 cap in a non-war zone. That's
pretty cool. But saying a word like war zone will be censored soon because that could be considered discriminatory. So I'm sure someone will have a problem with that. Just so
Peter said he's had long-term rentals for decades. His Airbnb units have been killing it. So this year, he will transition to a few more long-term rentals to short-term. And Jason, you've talked about that, about Airbnb, and a lot of it is if you have drivable Airbnbs, they're doing fantastic.
Yeah, good point. Good point. A lot of people with short-term rentals with doing the Airbnb thing have really suffered through this, but some have done really well. It's a very mixed bag. And I think the formula is, and I mentioned this way back in February or March of last year, the formula is that if you can drive to the property, usually, easily like 4 hours away, right? 4-hour drive or less. If you can drive to the property and it is, and that property is in a low density area where you can have a truly different experience than at home, meaning it's not the same type of environment. Like if you live at the beach already and you're just driving to another beach town, that's not significantly different, right? Or, whatever, right? But if you can have a different experience in a low density, considered safe environment, those Airbnbs are doing really well. But the ones where you got to get on an airplane and it doesn't really offer a different experience, those are suffering greatly. So it's very mixed with the Airbnb thing.
Yeah.
So.
And Nazik says Californians bringing their bad tax habits to other states. Sure, some of them are very good people per hour, great leader. Oh,
Yeah.
per hour, great leader.
Yeah, you meant OUR. I get it. It's typo. But Adam, you could probably. How long have you lived in Austin?
Most of my life. I mean, this is my third time around. We've been here. We moved here at the end of 2012. So we've been back for a little over 8 years.
Yeah. Well, you're on the left side of the political spectrum, but you seem to be pretty objective, when talking about this stuff. A lot of people in Austin have complained about that. Now, Austin is the most liberal place in Texas, obviously. It's actually quite liberal. And but it's in this, state that is, was at least more conservative. It's not anymore. And that's because of the immigration, right? I mean, these Californians, it's so interesting, and New Yorkers, they escape the high tax, business unfriendly, government intrusive environments, but then they go get on the city council in these new places and they vote in all the same kind of stuff that they ran from. Do you see that in Austin?
I've actually been surprised. People in Austin, even with all the California money and other money moving in, they don't vote to increase property taxes that much. I mean, they're already high, so
they're very high.
There's no income tax, but like we've had numerous things on the ballot in the past few years that could potentially help alleviate congestion because the city is planned horribly, and so there's very few good ways to get through the town, and they're not voting to increase taxes for roads or schools or this or that. So it hasn't increased as much as you might expect, with all the money moving in. People here are very curmudgeonly in that regard.
Yeah, interesting. Good stuff. Well, all right, folks, that'll wrap it up for today. We've got a podcast coming out this evening in the Creating Wealth Show. We're doing that now Monday, Wednesday, and Friday. We used to do 5 days a week, but we want to have some time to do some other stuff. So this year, our plan, if we can stick with it, is 3 days a week, every Monday, Wednesday, Friday on the podcast. We'll be live streaming on YouTube if the Communist Party of Silicon Valley continues to allow us to. The tech god. What's that?
Just keep poking the bear.
Yeah, poke the bear a little bit. Exactly. I love it.
You're going to ban me? All right, I'm going to call you communists.
The thing is, they are communists. I mean, I don't know that they'd actually deny that. But they might be proud communists, workers of the world unite.
That's the last thing they want.
Yeah. Why?
Oh, their workers. They don't want their workers united against them.
It's interesting that the Google employees just formed a union. I love that.
Yeah. See what happens to them.
Yeah.
They'll probably all get fired.
Well, no, they can't fire that many people. That's the thing about it. The internet is still partially free because they just can't track down every person and every creator that's putting out this content. But believe me, they're trying, and their algorithms get better every minute. So the free speech isn't going to last too long, folks. But anyway, look in the chat for 2 links. Click the like button. And Adam, thank you for joining us. And everybody, thank you for listening. And until this evening, when we have another podcast coming out, happy investing to all. Thanks for joining us. Bye-bye.